If you're a German business owner, a GmbH shareholder, investor or high earner, and you feel that between corporate tax, trade tax, the solidarity surcharge, and tax on every euro of dividends, Germany keeps more of your success than you do, then this video is for you. There is a legal route to keep far more of what you build in a fellow EU member state under 4 hours away and in the sun. The truth is simple. For entrepreneur, Germany in 2026 is a high tax country, a combined corporate burden of around 30%, and then roughly another 26% on the dividends you take out. By the time profit reaches you, close to half of your earnings have gone. In contrast, Cyprus is quite the opposite. It's an EU member state with 15% corporate tax, 0% tax on dividends for qualifying non-dom residents, no capital gains tax on securities, no inheritance tax, and for a German citizen, Cyprus offers the simplest immigration route of all, because as an EU national, you do not need a visa to live here. Moving from Germany to Cyprus is not simply a change of address. It has to be a coordinated plan across 2 tax systems. There's one German rule in particular which can turn a careless move into a very expensive one. In this video, I will give you the full roadmap of why German founders and families are choosing Cyprus. We will talk about lifestyle and tax, a direct Germany versus Cyprus tax comparison, personal and corporate, with a real-world example. I will also talk about the residency route for EU citizens, the yellow slip, Cyprus tax residency and the non-dom regime. Also setting up a Cyprus company the right way, and the German side you cannot ignore for deregistration, German tax residence, and above all, the exit tax. I will share the correct step-by-step way of doing it all properly. At Philippou law firm, we handle the whole relocation under one roof. The yellow slip, the non-dom registration, your Cyprus company, and coordination with your German advisors. We have over 40 years of experience and clients from more than 30 countries. Let's start with the question every German client asks first. Why Cyprus? We begin with what matters before any tax calculation, and that's life. If the lifestyle doesn't work, the tax saving is irrelevant. Cyprus gives you roughly 300 days of sunshine a year. Low crime, a genuinely family-friendly environment, and international schools in Limassol, Nicosia, Paphos and Larnaca. English is used as a matter of course in business, banking and law, so you're not operating in a language you don't control. It's an EU member state, so the legal certainty and the freedoms you're used to are still there. And it sits at a crossroads with easy access to Europe, the Middle East and the Gulf. Then come the tax advantages on top. 15% corporate tax, 0% on dividends and 0% interest for non-dom residents. There's generally no Cyprus withholding tax on dividends paid out to non-residents. There's no capital gains tax on securities and no inheritance tax at all. For a German family used to church tax, the solidarity surcharge and dividend tax north of 26%, the contrast is very sharp. Basically, you keep the EU framework you trust and change the tax outcome underneath it. But better needs proof, so let's put the 2 systems side by side. Let's compare the 2 systems on the points that actually decide your net wealth. Corporate tax. In Germany, a combined burden of around 30%. Once you add corporate income tax, the solidarity surcharge, and municipal trade tax, which is often higher in cities like Munich or Frankfurt. In Cyprus, 15% corporate tax, one of the lowest in the EU. Now, let's look at personal income tax. In Germany, progressive up to 45% top rate, plus the solidarity surcharge for high earners. In Cyprus, the first 22,000 euros is tax-free, rising to a 35% top rate. Dividends. In Germany, the flat investment tax, which is 25%, plus the 5.5% solidarity surcharge, so you get 26.375%, and church tax on top if you're a member. In Cyprus, for a non-dom resident, 0% income tax and 0% special defense contribution. Only the 2.65% health system contribution, which is also capped. Capital gains tax on securities. In Germany, these are generally taxed under the same 26.375% investment tax. In Cyprus, they're generally exempt. Inheritance tax. In Germany, yes, at meaningful rates. In Cyprus, none at any level on any asset. Church tax. Germany, 8 to 9% for members on income and on investment tax. In Cyprus, there's none. And the two systems connect through the Germany-Cyprus double tax treaty, which is exactly why timing and treaty analysis matter when you change residence. We can be talking about numbers and percentages for a long time. Let's, however, run a real example so that we can put facts to paper. Imagine a founder whose company makes 200,000 of profit and who wants to take that profit out personally. Let's follow it through both systems. I'll keep it simple so you can see the shape clearly. In Germany, first, the combined corporate burden of around 30% takes roughly 60,000 euros, leaving 140,000 euros. Then you distribute that as a dividend, and the 26.375% investment tax takes about 37,000 euros. More if church tax applies as well. So the total tax on that 200,000 euros is close to 97,000 euros, nearly half of the profit before it reaches your pockets. Now, in Cyprus, as a non-dom, corporation tax is 15%, and that's approximately 30,000 euros, leaving behind 170,000 euros. You distribute that as a dividend, and as a non-dom, that is 0% income tax and 0% special defense contribution. The only charge is the 2.65% health contribution, which on 170,000 is about 4,500, and it's capped at roughly 4,770 a year, no matter how large the dividend. So the total tax is around 34,500, which is about 17%. So here's the same 200,000 of profit, run through both systems. In Germany, you keep roughly 103,000 euros. In Cyprus, you keep roughly around 165,000 euros. That's about 62,000 euros more in your pocket every single year. Over a decade, that is well over €500,000 euros on this one example alone. These numbers are only real if you become a resident in Cyprus correctly. And as a German citizen, the residency part is refreshingly simple. So let's take a look at that. Here's the good news for German citizens. You're EU nationals, so you have the right to live in Cyprus. No visa, no investment requirement, no permit granted at anyone's discretion. There is just one registration to complete, and this is commonly known as the yellow slip. The yellow slip is formally the NEU1 registration certificate. This is how EU citizens register their residence in Cyprus. You apply within 4 months of arriving, and it unlocks everything else. Tax registration, social insurance, a bank account, schools, and proof of your move. Typical documents are your passport or ID, proof of a Cyprus address, evidence of work or sufficient resources, and health insurance. The permit is actually a formality, not an obstacle, but a registration certificate is not a tax residency. And that distinction is where a lot of people get into trouble. So now let's separate them. Residency from tax residency. Holding a yellow slip does not automatically make you a Cyprus tax resident. That's decided under the tax rules, and there are 2 ways to qualify. The first is the 183-day rule. You spend more than 183 days in Cyprus in the calendar year, and you're a tax resident with no further conditions. The second, and the one most internationally mobile founders use, is the 60-day rule, which has been revised for 2026. Broadly, you must spend at least 60 days in Cyprus and not spend more than 183 days in any single other country. You must also carry on business in Cyprus or hold an office, such as a directorship in a Cyprus company, and you must maintain a permanent home here. The key 2026 change in this was that the old condition that you must not be a tax resident anywhere else has been removed. That makes the rule easier to follow. But this also means that you can now be treated as a tax resident in 2 countries at once. The Germany-Cyprus treaty becomes more important, especially if you still have ties back in Germany. So count your days carefully and keep the evidence. Becoming a Cyprus tax resident is only half of the story. The piece that delivers the 0% on dividends is a separate status, and that's the non-dom status. The non-dom regime is the single biggest reason German entrepreneurs move to Cyprus. If you're a Cyprus tax resident who is not domiciled in Cyprus, which almost every new arrival from Germany is, then dividends are not subject to income tax, and they are exempt from the special defense contribution. Interest is exempt from the special defense contribution. The only charge that typically applies is the 2.65% healthcare contribution, which is capped at around 4,770 euros a year. The non-dom status lasts for up to 17 years. Now, the 2026 reform even added an option to extend it beyond that. For a German founder used to a flat 26.375% on every dividend, plus church tax, this is the part of the move that pays for everything else. But to take advantage of this properly, most people need the right vehicle for their income, which is usually a Cyprus company. So let's set one up. For consulting, e-commerce, SaaS, IP, investment holding, or simply invoicing clients internationally, a Cyprus private limited company is usually the best platform. From 2026, a Cyprus company is taxed at 15% on net profit, and a company incorporated in Cyprus is generally treated as a Cyprus tax resident unless a treaty says otherwise. Incorporation is straightforward. You have name approval, the memorandum and articles, a director, secretary, registered office, shareholder structure, tax and VAT registration. Most of this can largely be handled remotely. But there's one thing that matters more for German clients than almost anyone else. The company must have real substance in Cyprus. It must have genuine management and control here. A Cyprus resident director or board, decisions taken in Cyprus, a real office, proper accounts, Cyprus bank account, and clear evidence that Germany is no longer where the business is actually run. If the company is still effectively managed from Germany, the German tax authorities can treat it as a German tax resident, and German anti-abuse and control foreign company rules can apply. So substance must be real, not cosmetic. And that warning leads directly to the part of the move that German entrepreneurs underestimate the most. The real danger isn't how you arrive in Cyprus, it's how you leave Germany. First, anyone leaving Germany without moving to another German address must deregister from the local registration office. That confirmation is what lets you cancel German health insurance, deregister from the broadcasting contribution, and support the position that Germany is no longer your center of life. Second, German tax residence. Deregistering an address does not in itself end your German tax liability. If you keep a home available to you in Germany, or your family stays, or the business is still run from there, you can remain subject to unlimited German tax. You need to review what you keep: a dwelling, accounts, German source income, and notify the authorities with a final German return for the departure year. Third, and this is the big one, the exit tax. Here's the German rule that can tax you on a sale that never happened. Under Section 6 of the German Foreign Tax Act, if you have been a German tax resident for at least 7 of the last 12 years, and you hold 1% or more in a corporation, whether it's a GmbH, a UG, an AG, or the equivalent, then leaving Germany is treated as if you had sold those shares at market value on the way out. Germany taxes the unrealized gain. It is a tax on a sale that never happened, on profit you never received. So this is what it looks like. Say your GmbH is worth 500,000 and you originally put in 50,000 euros. The unrealized gain is 450,000. Under the partial income method, 60%, which is 270,000, is taxable at your personal rate, which at the top end is around 45%, plus the surcharge. That is well over 100,000 euros of tax, which is triggered purely by moving. There is, however, one bit of good news, because Cyprus is in the EU and Germany is in the EU. In 2022, Germany implemented a tax reform. which allows German citizens to pay the exit tax in 7 equal annual interest-free installments rather than all at once. But it still has to be reported, valued and planned before you leave, not discovered later. For any GmbH owner or founder, this is the single most important conversation to have before departure. Alongside this, there are 2 smaller but still real steps that need to be followed. The first one is adjusting your German health insurance and arranging cover in Cyprus, and to stop paying church tax if this is something that you have been paying. A successful relocation is done in phases, and the sequence matters as much as the steps themselves. First of all, 3 to 6 months before the move, a joint German and Cyprus tax review is necessary. Your German tax residence, your exit tax exposure, and whether you need a Cyprus company. 2 to 4 months before the move, secure Cyprus housing, plan your German deregistration, and review your German contracts, insurance, and business structure. Around the time of departure, complete the deregistration with the authorities within the legal window, notify the government, and prepare your final German return. On arrival in Cyprus, settle your accommodation, then submit your residence permit application. Then, once in Cyprus, you need to obtain your Cyprus tax identification number, track your days for the 60-day or the 183-day rule, and apply for tax residency and non-dom status. You also have ongoing things, which is to maintain compliance, accounting, VAT and substance in Cyprus, and watch the 17-year non-dom clock and any continuing German obligations. Follow that order and the move becomes a sequence of straightforward steps. Skip a stage, especially the exit tax review, and you create exactly the problems we spend our time unwinding. So let's sum it all up. The most common mistakes we see: leaving Germany without checking the exit tax and being hit with a 6-figure bill on shares you never sold; keeping a German home available and assuming German tax residence simply ended; failing to complete the deregistration or to cancel health insurance and the broadcasting contribution; setting up a Cyprus company with no real management and control in Cyprus; not tracking Cyprus days and missing the 60-day or the 183-day threshold for the year; confusing the yellow slip with tax residency. They're not the same thing. And the biggest one of all is treating the German side and the Cyprus side as 2 separate exercises instead of one coordinated plan. Every one of the mistakes I mentioned is avoidable with the right advice on both sides of the move at once. That's where we come in. Moving from Germany to Cyprus in 2026 is, for the right person, one of the most rewarding decisions available, financially and personally. An EU base, 15% corporate tax, 0% on dividends for up to 17 years, no inheritance tax, the simplest possible immigration route for an EU citizen, and a professional environment that works in English. But success depends entirely on timing, documentation and structure, and above all, on coordinating the German and the Cyprus sides as one plan, with the exit tax reviewed before you go. The complexity is real but manageable. A sequence of clear steps with the right team. Speak with our relocation team at Philippou. We handle the whole process: your yellow slip, the non-dom application, your Cyprus company and substance, and the coordination with your German advisors on deregistration and the exit tax, all under one roof. Let's make sure you keep what you've built.